March 26th, 2021. A Friday morning that started like any other on Wall Street. By noon, traders at Credit Suisse, Nomura, and Morgan Stanley were scrambling. By close of business, $100 billion in market value had evaporated. Within 72 hours, a man named Bill Hwang, someone most Americans had never heard of, lost $20 billion, not over years, not over months, in 2 days. His family office, Archegos Capital, imploded so spectacularly that it triggered over $10 billion in losses across the world's biggest banks. Credit Suisse lost $2.4 billion and was left so wounded it would later collapse entirely. Nomura lost $2 billion. Wall Street's confidence in risk management shattered. Today, we're dissecting the Archegos disaster. How one man used secretive financial instruments to build a $36 billion house of cards. How Wall Street's biggest banks enabled him, and why this collapse exposed systemic failures that threaten us all. This is the story of the loss that shook Wall Street. To understand the collapse, we need to understand the man behind it. The Tiger Cub. Bill Hwang, born Sung Kuk Hwang in South Korea, immigrated to the United States and earned degrees in economics from UCLA and an MBA from Carnegie Mellon. His big break came working for Julian Robertson at Tiger Management, one of the most successful hedge funds of the 1990s. Robertson was legendary. When he closed Tiger Management in 2000, he seeded several protégés with capital to start their own funds. These became known as Tiger Cubs, and they dominated hedge fund performance for the next 2 decades. Robertson gave Hwang approximately $25 million to launch Tiger Asia Management in 2001. Hwang was considered one of Robertson's most promising disciples. Early success. By the mid-2000s, Tiger Asia had grown to over $5 billion in assets under management. Hwang developed a reputation for aggressive, concentrated bets, particularly on Asian technology and media stocks. His returns were spectacular. Investors flocked to him. He was making hundreds of millions personally. On Wall Street, Bill Hwang was a rising star. The first fall, in 2008, Tiger Asia suffered heavy losses during the financial crisis. But worse was coming. In 2012, the SEC charged Hwang and Tiger Asia with insider trading involving Chinese bank stocks. The allegation, Hwang had received confidential information about pending stock offerings and traded ahead of public announcements. Hwang and Tiger Asia settled without admitting or denying guilt, paying $44 million in fines. More damaging, the settlement banned Hwang from managing publicly raised capital, effectively shutting down his hedge fund. In Hong Kong, regulators went further, banning Hwang from trading stocks on the Hong Kong Stock Exchange for 4 years. For most people, this would be the end, but not for Bill Hwang. The transformation into Archegos. In 2013, Hwang converted Tiger Asia into a family office called Archegos Capital Management. The name comes from a Greek word meaning one who leads the way. Here's the critical detail. Family offices operate under dramatically different regulations than hedge funds. Hedge funds managing outside investor money face SEC registration, reporting requirements, and disclosure obligations. Family offices, managing only the wealth of a single family or the manager's own money, face almost none of these requirements. Archegos didn't have to register with the SEC. It didn't have to file public reports. It didn't have to disclose its positions. Hwang had found a loophole that would allow him to build a multi-billion-dollar empire in complete secrecy. The devout Christian billionaire. Throughout this period, Hwang maintained a carefully cultivated public image. He was deeply religious, reading the Bible for hours weekly. He and his wife lived modestly in suburban New Jersey, rarely socializing despite his wealth. He founded the Grace and Mercy Foundation, a charitable organization focused on Christian causes. By 2018, the foundation held over $500 million in assets. To the outside world, Bill Hwang appeared to be a reformed trader who'd learned from his mistakes, dedicating himself to faith and philanthropy. Behind the scenes, he was building the biggest financial time bomb since the 2008 financial crisis. To understand how Archegos collapsed, you need to understand the financial weapon Bill Hwang wielded: total return swaps. What are total return swaps? A total return swap, TRS, is a derivative contract between two parties. Let's simplify. Party A, in this case, a bank like Credit Suisse, agrees to pay Party B, Archegos, all the returns, capital gains plus dividends on a specific stock or basket of stocks. Party B, Archegos, agrees to pay Party A a financing fee, essentially interest, and absorbs all the losses if the stocks decline. The critical feature: Party B gets all the economic exposure to the stocks without actually owning them. Why this matters? When you buy 10 million shares of a company, you must disclose this to the SEC if it exceeds 5% of the company's outstanding shares, Form 13D. Everyone knows your position. With total return swaps, you get the same economic exposure, but don't legally own the shares. The bank owns them. You're just exposed to their performance through a contract. Result? No disclosure requirement. Your position is invisible. The leverage multiplier. Here's where it gets explosive. Normally, if you want $100 million in stock exposure, you need $100 million in capital. With total return swaps, you might only need to put up $10, $20 million as collateral, the margin. The bank fronts the rest. This is 5-1 or 10.1 leverage. For every dollar Hwang invested, he could control $5, $10 in actual stock exposure. Hwang's strategy. Between March 2020 and March 2021, Hwang used total return swaps to build massive concentrated positions in a handful of stocks. Viacom CBS, later Paramount, Discovery Baidu, Tencent, Vipshop, GSX, Takedo, Farfetch. His largest position was Viacom CBS, where Archegos had approximately $5.1 billion in exposure. Roughly 48% of Viacom CBS is outstanding shares through swaps across multiple banks. The growth trajectory. SEC complaints later revealed the scale. March 2020, Archegos had $1.5 billion in value with $10 billion in stock exposure. March 2021, peak. Archegos had $36 billion in value with $160 billion in total exposure. That's over 10.1 leverage. For every $1 Archegos had, it controlled $16 in stocks. Why banks enabled this? Banks love total return swaps for one reason. Fees. Every swap generates financing fees, interest payments from Archegos, trading commissions, prime brokerage fees. Credit Suisse was earning millions monthly from Archegos. The relationship was extraordinarily profitable. Moreover, banks believed they were protected. If Archegos couldn't meet a margin call, the bank could simply sell the underlying stocks and recover its money. This logic worked until everyone tried to sell simultaneously. The deception. Here's what prosecutors later charged. Hwang deliberately misled banks about Archegos' total exposure. Each bank thought it was Archegos' primary lender. None knew the full scale of positions held across competitors. When Credit Suisse asked about concentration risk, Archegos provided vague or evasive answers. Internal Credit Suisse investigations later found staff failed to flag obvious warning signs. The revenue was too good to question. Now we reach the catastrophe. How did $36 billion disappear in 72 hours? Monday, March 22nd, 2021. The fuse is lit. Viacom CBS announced a surprise secondary stock offering, selling $3 billion worth of new shares to raise capital. For most companies, this would be routine. But Hwang's massive hidden position through swaps had artificially inflated Viacom CBS stock price over the preceding year. The stock had risen from $20 to $100 per share. When Viacom CBS announced the offering, the market interpreted it as dilution. The stock price began falling. Hwang made a catastrophic decision. He doubled down. Archegos invested another $900 million into Viacom CBS swaps, trying to prop up the price. It didn't work. Other investors sensed something wrong and started selling, and the stock continued declining. Tuesday, March 23rd, the margin calls begin. As Viacom CBS shares fell, Archegos' portfolio value plummeted. Remember the leverage. A 10% drop in stock prices meant a much larger percentage loss for Archegos as actual capital. Credit Suisse risk managers scheduled emergency calls with Archegos to demand additional collateral, margin calls. All were canceled at the last minute by Hwang's team. Incredibly, despite alarm bells, Credit Suisse's prime brokerage desk provided an additional $2.4 billion in financing to Archegos during these crucial days. Trial testimony later revealed the chaos. Archegos staff taking calls with panicked bankers while going through airport security. Risk officers frantically texting as the portfolio crashed. By end of trading Tuesday, Archegos was fielding $2.5 billion in margin calls after its portfolio dropped 10%. Wednesday, March 24th, the death spiral. Viacom CBS shares continued falling, down 27% in a week. Discovery, another major Archegos holding, dropped similarly. Multiple banks now demanded massive margin calls totaling billions. Archegos CFO Patrick Halligan and risk chief Scott Becker tried projecting calm. Internal messages reveal gallows humor. "I had a nice nap," Becker texted. "We had pasta last night, so I was up with alarms humming Lionel Richie's all night long in my head," Halligan replied. Behind the scenes, panic. Archegos was making frantic wire transfers, trying to meet margin calls from different banks simultaneously. Goldman Sachs and Morgan Stanley's risk teams began connecting dots. They realized Archegos had similar massive positions with multiple banks. If one bank started selling, it would trigger a cascade. Thursday, March 25th, the fire sale. Goldman Sachs made the decisive move. Without warning Archegos or other banks, Goldman began liquidating its Archegos positions. Morgan Stanley and Deutsche Bank quickly followed. These banks dumped billions in Viacom CBS, Discovery, Baidu, and other stocks onto the market simultaneously. stock prices cratered further. Credit Suisse and Nomura, slower to act, watched in horror as the stocks they held as collateral became worthless. Friday, March 26th, total collapse. Viacom CBS shares opened down another 23%. Discovery fell similar amounts. Nearly $100 billion in market capitalization evaporated from Archegos-related stocks. Credit Suisse finally moved to liquidate its positions, but the market was saturated. They couldn't sell without driving prices even lower. At Archegos, staff gathered for a Zoom meeting. Diana Pai, the co-president, delivered the news. The firm was worthless. Archegos was moving into shutdown mode. Bill Hwang had lost $20 billion in 2 days, one of the largest personal financial losses in history. Just 1 week earlier, he'd gathered staff at his corporate apartment to discuss growing Archegos to $100 billion in the aftermath. When the dust settled, Credit Suisse, $2.4 billion in losses, later contributed to the bank's total collapse and absorption by UBS. Nomura, $2 billion in losses. Morgan Stanley, minimal losses, quick action. Goldman Sachs, minimal losses, quick action. Total bank losses, over $10 billion collectively. Credit Suisse shares fell 14% in a single day. Nomura shares fell 16%. Archegos staff were jobless. Hwang's fortune, once $36 billion, was gone. The story doesn't end with financial losses. In April 2022, federal prosecutors indicted Bill Hwang. The charges: the Department of Justice charged Hwang with securities fraud, multiple counts, wire fraud, market manipulation, racketeering conspiracy. The allegation: Hwang didn't just make bad bets, he deliberately manipulated stock prices and defrauded banks. Prosecutors argued Hwang used Archegos to artificially inflate stock prices through massive coordinated purchases, create false market signals that induced other investors to buy, deliberately mislead banks about Archegos' concentration and risk, lie about his ability to meet margin calls. Also charged Patrick Halligan, CFO, William Tomita, head trader, and Scott Becker, chief risk officer. The prosecution's case. At trial, prosecutors presented damning evidence. Recorded phone calls showing Hwang's team evading questions from banks, internal Archegos emails revealing knowledge of extreme concentration risk, trading data demonstrating coordinated price manipulation, bank testimony describing misleading or false statements from Archegos. Key witnesses included Archegos' former head of risk and head trader, who both pleaded guilty and testified against Hwang. One particularly damaging incident: Archegos accidentally sent Goldman Sachs nearly $500 million, then called begging for it back, revealing their liquidity crisis. The defense: Hwang's lawyers argued he was a legitimate investor making legal, if highly risky, trades. The losses resulted from miscalculation, not fraud. They portrayed him as a devout Christian philanthropist who believed in his investment thesis and lost everything when the market turned against him. The verdict: on July 10, 2024, after weeks of testimony, the jury found Bill Hwang guilty on multiple fraud counts. U.S. Attorney Damian Williams stated, "This verdict should send a resounding message that this office will continue to police the financial markets with an eagle eye and swiftly hold accountable those who think they can cheat the system." Hwang faced up to 20 years in prison per count. Sentencing. On November 20th, 2024, Bill Hwang was sentenced to 18 years in federal prison. At age 60, this effectively means he will spend the rest of his active life behind bars. The judge noted the historic scale of the fraud and the billions in losses inflicted on banks and investors. Patrick Halligan was also convicted and faces sentencing. The Archegos collapse wasn't just about one rogue trader. It exposed systemic failures throughout Wall Street. Failure number 1, risk management. How did banks lend $160 billion to one family office without understanding the full picture? Internal investigations revealed shocking lapses. At Credit Suisse, risk managers repeatedly flagged Archegos as concerning. These warnings were ignored by the profit-focused prime brokerage desk. One Credit Suisse risk officer testified they relied on Hwang's pinky promises about his total exposure rather than conducting independent verification. Multiple banks never required Archegos to disclose positions held with competitors. Each assumed they were the primary lender. Failure number 2, regulatory loopholes. Family offices like Archegos operate in a regulatory blind spot. Hedge funds managing outside money must register with the SEC, file quarterly. 13F reports disclosing holdings. Comply with disclosure requirements. Face regular examinations. Family offices managing only personal family wealth face almost none of these requirements. Archegos never filed a 13F report in its 8-year existence. This allowed Hwang to accumulate positions exceeding 48% of some companies' shares without triggering disclosure rules. The SEC has broad authority to change these thresholds, but hasn't. Failure at UNVER 3. Total return. Swap. Transparency. TRS contracts create phantom ownership, economic exposure without legal ownership. Current regulations don't adequately address this. Beneficial ownership rules requiring disclosure above 5% ownership don't apply to swaps. Result, investors buying stocks have no idea that positions might be concentrated in undisclosed swap arrangements. Failures in UNVER 4. Bank coordination. When the crisis hit, banks competed rather than cooperated. Goldman Sachs and Morgan Stanley saved themselves by selling first and fast, pushing losses onto Credit Suisse and Nomura. There was no mechanism for banks to coordinate or even share information about a common client's total exposure. The Credit Suisse dimension, Archegos didn't just cost Credit Suisse $2.4 billion in direct losses. It shattered confidence in the bank's risk management. Already facing scandals, Greensill capital collapse, money laundering investigations, the Archegos disaster was the final straw. Investors lost faith. When Silicon Valley Bank collapsed in March 2023, triggering panic about bank stability, Credit Suisse faced a run. The Swiss government orchestrated an emergency takeover by UBS. A 167-year-old banking institution, once one of the world's largest, ceased to exist. The Archegos scandal was a key contributor. What's changed? Since Archegos, some banks have tightened prime brokerage requirements. Regulators are examining family office oversight. Proposals exist to subject large family offices to the investment advisors. Banks are more cautious about concentration risk. But fundamental reforms haven't passed. The family office loophole remains. Total return swap disclosure requirements are unchanged. The question? Federal Reserve Chair. Jerome Powell said the Fed was monitoring Archegos carefully. Congress held hearings. But will anything fundamentally change before the next Archegos? What have we learned? The Archegos disaster reveals uncomfortable truths about modern finance. 1. Leverage multiplies gains and losses exponentially. When Hwang's bets worked, he became a billionaire. When they failed, $20 billion evaporated in 48 hours. 2. Regulatory loopholes create systemic risk. The family office exemption allowed Hwang to operate in shadows, building positions that threatened global banks without public knowledge. 3. Banks prioritize profits over prudence. Credit Suisse staff knew Hwang was risky, but continued enabling him because the fees were too lucrative. 4. Interconnection amplifies crises. When one bank moved to protect itself, it triggered a cascade affecting institutions worldwide. 5. Consequences aren't equally distributed. Goldman and Morgan Stanley escaped unscathed through quick action. Credit Suisse and Nomura suffered billions in losses. Ordinary Credit Suisse employees lost jobs when the bank later collapsed. The human cost, beyond billions in bank losses, consider Credit Suisse employees who lost careers when the bank failed investors in Viacom CBS and other stocks who saw holdings crater retirement accounts exposed to these equities. Taxpayers in Switzerland who backstopped the UBS rescue. The final irony? Bill Hwang presented himself as a reformed trader dedicated to Christian values and charity. His foundation gave millions to religious causes, yet his actions caused billions in losses and contributed to a bank's destruction. Federal prosecutors called it one of the most audacious frauds in Wall Street history. The jury agreed. Bill Hwang will spend his final productive years in prison. The warning? Archegos won't be the last. As long as leverage is available, regulatory loopholes exist, and profit incentives override caution, similar disasters will occur. The next family office, building a house of cards, could be operating right now. Banks might be enabling them. Regulators might not know they exist. The question isn't whether another Archegos will happen, it's when. And whether next time the losses will be contained or trigger something worse. Final thought. In March 2021, most Americans had never heard of Bill Hwang or Archegos Capital. Within 72 hours, his collapse triggered $10 billion in bank losses and helped topple a 167-year-old financial institution. The scary part? Archegos managed $36 billion. There are family offices managing hundreds of billions, operating under the same regulatory exemptions, using the same opaque instruments. We got lucky that Archegos imploded relatively early, before it grew to $100 billion as Hwang planned. Next time, we might not be so fortunate.